Welcome to my channel. I'm Scott, and in this video we're going to talk about dividends. The topics we're going to cover are the high-level explanation of dividends, the dates you need to consider, what is the dividend yield, dividend taxes, red flags to look out for, and how many stocks actually pay dividends, which ones pay monthly dividends, and then a summary. So the high-level definition of a dividend is when a company pays cash to its shareholders. No strings attached, the company just gives you cash. Some companies do pay stock dividends, but we're just going to talk about cash dividends in this video. Before you ever receive a dividend, the company's board of directors gets together and tries to answer three questions. Will they even pay a dividend? How much will they pay? And how often will they pay the dividend? Will it be monthly? Will it be quarterly? Will it be annually? About half of the US stocks do not pay a dividend. So if a company does not pay a dividend, what do they do with their extra money? Well, the first thing is, before you even consider what a company does with their extra money, there are a lot of companies that lose money. They have no extra money, so they cannot pay a dividend. But what about the companies that do have excess funds that do not pay a dividend? Well, there's three things they could do with the money. They could invest back into the business, they could acquire another company, they can buy factories, whatever they want with the money. They could pay down debt, or the company can buy back stock, which is an alternative to paying a dividend, because when a company buys back stock, it decreases the shares outstanding. It makes your share more valuable. It gives you a bigger piece of the pie. And you'll see many companies do all four. They pay a dividend, they buy back stock, they sometimes pay down debt, and they invest back into the business. So how do dividends work? When you own a share of stock, you own a piece of the company. You're an owner of that company. I created this chart in Excel, so if you're a member of my Patreon page, you get access to all this information. Pretend there are 1 million slices on this chart. So for this example, a company has 1 million shares of stock. Each slice is a share. They plan to pay $1 million of dividend payments. That means each shareholder receives $1. But what if you own 100 shares? Then you receive $100. We're going to calculate the dividend yield in a few more slides, so we'll get into more detail. But this is the really basic way to think about it. So once the board of directors gets together and they decide how much money they plan to pay in dividend payments, they announce it, a declaration date. They tell everybody how much they plan to pay. The most important date is the ex-dividend date. When you hear X, think of without. My ex-wife, without wife. Ex-dividend, without dividend. So if the ex-dividend date is March 14th and you buy the stock on March 14th, it's without dividend. You will not get the dividend. If you buy the stock after March 14th, you will not get the dividend. You have to buy it before March 14th. If you own the stock for many years already, then it doesn't matter. But if you buy the stock for the first time, it has to be before the ex-dividend date, because it could take the company a day or two to identify all the holders on record, so they know who to pay the dividend to. And then sometimes a month or 2 months later, the dividend is paid. And most people receive the cash right in their brokerage account. On the ex-dividend date, the stock price is adjusted downward by the amount of the dividend. Due to the natural forces of the stock market, you may not even notice a change in stock price. If the company paid a 1% dividend, then that means the stock price should go down 1%. But if the stock price actually goes up 2%, that just means it would have went up 3% if they did not pay the dividend. The reason the stock price goes down is because the company is worth less. Retained earnings are reduced by the total amount of the dividend. If you think of it logically, it makes sense, but let me give you an example. Say you wanted to start a landscaping business and you asked your father for $50,000. Your father is a little concerned about giving you the money, but he just wants to get you out of the house. And he says, this is not a loan because I know it's going to be hard for you to pay me back. I own 100% of the business, but you could take all the profits. And you say to your father, I'm so confident I'm going to pay you back at the end of the year. And your father just kind of rolls his eyes and says, fine. So you get the $50,000 on January 1st, you buy a bunch of equipment, hire a couple of friends, and you actually do a really good job. You're landscaping for most of your neighbors and you're getting a lot of referrals. So you show your father your balance sheet at the end of the year. Your father says, wow, I gave you $50,000 and you have $90,000 of cash and $60,000 of equipment and you owe $20,000. And your father is really impressed. He says, I gave you $50,000 and now your company is worth almost triple that amount, $130,000. As you promised, you give your father a check for $50,000 for his dividend payment. So your cash goes down $50,000. Your cash is now $40,000. And that means your equity is $50,000 less. Your equity is $80,000. Your company is now worth $80,000. Isn't it logical to think that your company is worth less after the dividend payment? It's the same thing with a big corporation. If you were curious on the mechanics of how the dividend works, when a company announces the dividend, their equity balance goes down and they post a liability, dividends payable, because no cash left the company when they announce it. But when the company actually pays a dividend, cash goes down and then that dividends payable goes away. But common stock dividends do not affect the income statement. What is the yield? You hear the bond yield, the dividend yield, but what does yield even mean? It just means the return on an investment. So how do you calculate the dividend yield? How do you calculate the return on your investment by looking at the dividend? If a company had 1 million shares outstanding and they paid $1 million in annual dividends, this means each shareholder receives $1 per year. If you own one share, you receive $1. They may pay you quarterly, 25 cents per quarter. They may pay you annually, $1 per year. It doesn't matter how often they pay you, you just need to annualize that number. So if it's a quarterly dividend, you have to multiply it by 4. If it's a monthly dividend, you have to multiply it by 12. So if one share is trading at $10, you can buy one share for $10 and you get a $1 dividend for the year. That means the yield is 10%, 1 over 10. You invested $10 and you receive $1. What if each share cost $100? Well, you invested $100 and then received $1 for the year. So your yield is 1%. So you can see as the stock price goes up, the yield goes down. And as the stock price goes down, the yield goes up. How are dividends taxed? They may be taxed as ordinary dividends if you hold the stock for less than 60 days. If you bought Microsoft stock and received the dividend the following month, you would pay taxes at the ordinary rate, which is the higher rate. That's the rate you pay at your job. If you're in college and you only make $2,000 a year working part-time, you only pay 10%. So if you received $100 in dividend payments for the year, you would pay $10 in taxes and you would keep $90. If you're a high-power CEO and you make $1 million a year, you would pay taxes at the higher rate. So if you received $100 in dividend payments for the year, you would pay $37 in taxes and receive $63. If you own Microsoft or any stock for 60 days or more and receive a dividend payment, you pay qualified taxes, which are the lower tax rate. So if you're a college student not making any money, you don't pay any taxes. If you're a high-power CEO making a lot of money, you pay 20% in taxes. It gets a little hairy with REITs, MLPs, and BDCs. MLPs are master limited partnerships, and BDCs are business development companies. Pretty much all the dividends you pay the higher rate. There can be some situations where you pay the lower rates, but you should assume most of the dividends you're going to pay the higher rate when you own these investments. Say you own Microsoft and receive a dividend payment in your brokerage account. You have to pay taxes even if you do not withdraw the money or if you invest it back into the company. It doesn't matter. You have to pay taxes. But you do not pay taxes on a retirement account. Dividends are not taxed when you receive them. You may see some stocks with really high dividends, 20%, 30%, and you wonder, how can it get this high? Why isn't everybody buying the stock? It could be a really big red flag if the dividend is that high. There's a decent chance they cannot sustain that dividend payment, or they may cut it altogether. I'll show you a common way a dividend gets really high. Say a company announces they're going to pay a monthly dividend, $1 a month. On January 1st, the stock is trading at $250. To calculate the dividend yield, you have to annualize the dividend. Since it's a monthly dividend, you multiply it by 12. It's $12 divided by $250. The dividend yield is 4.8%. But you decide not to buy the stock. You check in on February 1st, and now the price went up to $300, so you're a little upset. And you calculate the dividend yield, 12 over 300. It's 4%. The yield went down since the stock price went up. Then you notice on March 1st, the stock is now trading at $220. So the yield is $12 divided by $220, 5.5%. the yield went up a lot. So you consider buying the stock, but you hold off. And then on April 1st, you notice the stock is trading at $80. So now the yield is 12 divided by 80, 15%. You see, the company never changed their dividend payment. It's still $1 a month. But the yield shot way up because the stock price came way down. Now you have to look, did the stock price come down because they're having a lot of trouble? Now, if you do more research on the company and you see they're in a big lawsuit, they lost one of their major customers, then maybe you understand why the stock price has come down. And there's a good chance the company will cut their dividend. Even though they said they're paying a monthly dividend of $1, they could change it at any time. They could cut their dividend to 50 cents or cut it to zero. That's the risk when you own stock. There's no guaranteed dividend payment. There is a guaranteed dividend payment for preferred stock and a guaranteed interest payment for bonds. But for common stock, there's no guarantees. But on the other hand, if you notice the stock price went down because the entire market went down and the company is doing fine, maybe then it's a good time to buy the stock. Even if the company is not doing poorly, they may just cut their dividend to be more in line with the stock price. I downloaded every single US stock. There was 2,511. And I posted all 2,511 stocks and also all the charts on my Patreon channel. Almost exactly half the stocks do not pay a dividend. 47%, 1,183 stocks. 1/4 of the stocks pay a dividend below 2%, 665 stocks. 429 stocks, 2% to 4%. 123 stocks, 4% to 6%. 48 stocks, 6 to 8%. 25 stocks, 8 to 10%. And 38 stocks, over 10%. If it's over 10%, you want to double check the numbers are correct and it's not a company that's in a lot of trouble. If there were two stocks, one with a 6% dividend, one with a 5% dividend, you'd probably take the one with a 6% dividend. But what if the stock that paid a 6% dividend is a REIT? You may be better off with the 5% dividend because after taxes, you may have more money left over. Of course, that depends on your tax rate. I did a bunch of Google searches to try to find all stocks that paid a monthly dividend. I found 15 stocks, and these are the yields. REITs tend to pay high dividends because they avoid double taxation. As long as they pay out at least 90% of their profits back to their investors in the form of a dividend, they can really reduce the amount of taxes they pay. Because for a regular company like Microsoft, they have to pay taxes on their profits and then they pay dividends on those profits. So you receive the dividend and you pay taxes on the dividend. That's double taxation. The company pays taxes, then you pay taxes. But with a REIT, they don't pay taxes, they pass it all on to you. But of course, you still have to pay taxes. But since the REIT doesn't pay taxes, there's more money left over to give back to their shareholders. That's why they tend to pay high dividends. To summarize, a dividend is usually a cash payment from a company's profits that is paid to investors. The reason I capitalize usually is because it's not always a cash payment. They may pay you in stock. If a company pays quarterly dividends, $2.50 each quarter, if you own one share, you get $10 of dividends. But what if the stock is trading at $10 and they give you one share of stock? It's pretty much the same thing because you can just turn around and sell the stock and get the $10. Also, sometimes companies are not profitable and they still pay dividends. How do they pay dividends if they're not profitable? They either raise capital by issuing debt or stock. Because when a company cuts their dividend or eliminates it, that's a signal to investors there's problems. And then investors may start selling the stock and the stock price comes crashing down. So lots of companies like to start off with a small dividend payment, a payment they can afford, and then every year increase it by a few percent. And there's lots of companies like Facebook that are looking to grow and scale, so they pay no dividends. They invest back into the business. But generally, companies that pay dividends are stable and more established. And most US stocks pay dividends on a quarterly basis. A lot of international stocks I looked at pay dividends annually or semi-annually. Please leave a comment and let me know what other types of videos I should do in this format. And please subscribe if you haven't and give it a like. It really helps me a lot.